Hello, in today's video we're going to be taking a look at the SPX CBOE index and utilizing the day trading GPS SPX Daily Key Levels indicator, and specifically our newest version of the indicator that was just released, which is V2.0. Today is Monday, September 22nd, 2025, and it's currently around 1:12 p.m. and we're looking at the chart of today's session. Okay, so the way this indicator works, if you haven't seen our other videos, is that at 9:30 a.m. Eastern New York time, you will have today's key levels on your chart as you see them now. Most important level is the SPX Bull Bear KPL, which stands for Bull Bear Key Price Level. After analyzing recent price action, volatility, and other factors, this is the indicator's most important level for the session, the Bull Bear Key Pivot Level for the session. So what this means is bullish above this level and bearish below this level. So this helps you with the bias for today's session, as whether it is a bullish session or a bearish session. In the early part of the session, from 9:30 for the first few candles of the session, the Bull Bear Key Price Level serves as an entry signal level for the opening price action. So for example, in today's session, we had a close above on the opening 9:30 a.m. candle above the Bull Bear Key Price Level. So this is indicating bullish bias for today's session. Your main levels R1 through R6, which we have here on the chart. We're not showing all the way up to R6. We've got it condensed down where we're just showing R3 above and S2 below. Your main levels and your midpoint levels above are your take profit levels for entry signals given by the Bull Bear Key Price Level. So on entries taken from the Bull Bear Key Price Level, specifically bullish entries taken from that level, your main levels R1, R2, R3, as well as your midpoint levels above are going to be take profit levels for entries that you've taken from a signal from the Bull Bear Key Price Level. Conversely, if we had a bearish bias for the session and we had instead a close below the Bull Bear Key Price Level and we had a bearish entry signal in the beginning moments of the session, and you took a bearish entry, specifically a put option, then your take profit levels are the main levels and midpoint levels below the BBKPL. So we'll be referencing throughout the rest of this video, for the most part, the Bull Bear Key Price Level as the BBKPL. The levels that you will see by default with this indicator are going to be the Bull Bear Key Price Level, your R1 through R6 levels, as well as your S1 through S6 main levels. And then you're going to also have the first midpoint level above the BBKPL and your first midpoint level below the BBKPL. Also by default, you're going to have the first quarter level, which is represented by QL, the first quarter level above, which is known as QL above BBKPL, and the first QL below the BBKPL. So you will have these main levels as well as these two midpoint levels and the two QL levels. The other midpoint levels are all optional to turn on. We do have a setup and features video which goes into more detail about all the inputs in the user control panel, and goes over all the features of this version of the indicator. If you would like to see that video as well, you can email us at daytradinggps@gmail.com and we can send you the link so you can see that. That video is about an hour long and goes into great detail about all the features and setup and inputs. In this video, we're not going to go over those. However, we will go over all the different levels here and what they represent. Okay, so the midpoint levels above and below serve a dual purpose. One of the purposes is to gauge continuing momentum in the specific bias of the session. So in a bullish bias of the session, the midpoint levels between each main level are there for gauging further momentum. Specifically, closes above the midpoint levels typically represent further momentum that it's going to seek out the next level, main level above. And the same thing in reverse. For bearish activity, closes below midpoint levels between each main level represent price action is seeking the next main level below. The QR levels, the QL above and below levels represent, on this bull bear key price level here, represent your tight stop loss levels on entries from any main level. You can also turn on the QL levels above and below any main level. So you can have a QL above R3 and a QL below R3. A QL above R2 and a QL below R2. A QL above S1 and a QL below S1, and same thing for S2. So those would represent your tight stop losses, and we have them on all the levels because later on in the session, not the first part of the session, but later on in the session, there will be entries that you can take, either bullish or bearish, off of the other main levels. Now we do have other videos that go into detail about taking bullish or bearish entries off of the other main levels later on in the session as time rolls on, and how you would do that. But basically it's the same concept as far as close above or close below the level as far as what price action is showing you. And then your stop losses would be the same on other levels as I'm about to explain on the bull bear key price level here, as far as using your tight stop loss or standard stop loss. Alright, so for today's session we have a close above on the initial 9:30 a.m. candle. So we have bullish above the BBKPL and we have a close above the BBKPL. So your entry on this, your bullish entry on this candle here, you would use a call option. In most cases that would be an at the money call option closest to the on the strike closest to the price of the BBKPL, which in this case 66.4569. So that would be a 66.45 0DTE call option. Upon taking that entry, your tight stop loss, if you prefer for your risk profile to use a tight stop loss on an entry that's triggered by the BBKPL, is the first QL below the BBKPL. A standard stop loss level on the same entry, if you prefer to use the standard stop loss level instead, would be the first midpoint level below the BBKPL, which is your mid BBKPL S1. So upon taking this bullish entry here, 66.45 at the money call, closest to this, your tight stop loss, if you prefer to use that, is this level here, the QL below. Your standard stop loss is this level here, the mid BBKPL S1. You don't necessarily have to use the at the money call option. If you are going to use out of the money call options on this early session entry on a bullish entry triggered by the BBKPL level, you would only want to consider one of two out of the money options. So if you don't want to use an at the money option, your next alternative is to use a call strike that is closest to the first midpoint level above the BBKPL, which is this level here, 66.5143. So you would use a 66.55 call as your first out of the money call alternative if you don't want to use an at the money call. Your second alternative would be using the call strike closest to the R1 level of 66.5717, which the closest call strike to that level is 66.55. Now, in using this indicator, there's no rule or obligation that you have to take an entry off of the initial candle of the day at the 9:30 candle. A lot of people like to take an entry off of the first candle, so if you are taking off of the first entry candle, then you're either looking for this gap above and close above, primarily as long as it's not too far above. If it's more around this R1 level, then you would not take an entry off of the bull bear key price level in using those. You would instead wait. If this close was closer to here on this R1 level, then you wait for a close above the R1 level to then take an entry off of the R1 level. But since it's contained within here, and we also have this long wick here, which is going down to this quarter level just above the BBKPL, this entry would be fine here for taking an entry signal off the BBKPL and using that as your entry signal level. However, keep in mind there is no rule or obligation that says that you have to take an entry off of the first candle. If you're the type of trader that likes to let the market breathe a little bit and let the market shake out a little bit in the opening part of the session, then if you were doing that, then your alternative entry would have been here on this candle here at the 940 candle, which we pointed out here alternatively, and that would still be an entry off the bull bear key price level. You also could have entered on these candles as well, but this would primarily be your entry candle here on this pop back above. But normally, if you're going to take one, you should just take it off of the entry candle if you're going to be more inclined to take it earlier in the session. So in that case, what you're looking for is if it's gapping above, as long as it's not above this R1, then you are looking for either price to go down. It could still cross intercandle, but as long as it closes above. So you're looking for either a cross above and close above, or if it gaps above, then you're looking for a close above as well, as long as that close and candle is not near or above the R1 level. In the case of that, then you would be taking your entry off of the R1 level once it shows it's sustaining above it and closing above it. Okay, so let's say that you had that situation. You waited and waited and waited. So now your first entry here, let's say you did not enter in any of this here, then and you're waiting, then you could have an entry here on this cross above and close above R1, and also you could have done it on this candle on further confirmation of cross and close above. In that case, you'd be taking a call strike closest to the R1 level of 66.5717, and your call strike closest to that is for at the money would be 66.55. And you would use the same rule on this entry that we, as far as out of the money options, that if you did not want to use an at the money option, then you simply look to the next midpoint level above, which in this case 66.6291. The closest to that is going to be your 66.65 call, and you would look to the next main level above that, 66.68.65. So the closest call strike to that is 66.70. So if you waited till here to take your entry, then it's either at the money closest to this strike, 66.55, or first alternative out of the money closest to this strike, or this. So it's the same process of out of the money closest to the first midpoint level above the level that you're taking the entry from, that it's triggered from, or the first main level above the level that the entry was triggered from. Okay, now we're just going to go back to this initial entry here and look at the three options that you had. So on this entry here, 66.45 was the call strike. The price on the close of this candle here was $13.60. If you instead chose the first out of the money alternative call strike closest to this level, that would be the 66.50 call. The entry price on the close of this initial candle here was $10.31 on the 66.50 call. And finally, if you put the furthest out of the money call that you should consider for an entry off of the BBKPL from this level here, the closest strike was 66.55. So the price on that on the close of this candle here was $7.60. Regardless of which one of those that you took on this candle, it's the same tight stop loss level or standard stop loss level. However, just to clarify, if you instead waited to take your entry off of the R1 level, then you would use the same process as you did here. So you're on an entry here, then your tight stop loss would be the QL below, the first QL below R1, and your standard stop loss would be the first midpoint level below R1. So I'll go ahead and turn on the QL below R1. And you can see that's this level here. So if you did this entry here, which is the 9:50 a.m. candle or the 9:52 a.m. candle, your tight stop loss would have been this QL below R1, and your standard stop loss first midpoint level below R1. Going back to, we're going to track only one call option here, because we really didn't have room to put all three of them up here on each one. We're just going to track the at the money call option, the 66.45. So at 9:50 a.m., SPX hits R1. Remember, you entered here, you paid $13.60. When it hits R1, your call, 66.45 call, is now $15.41. 16 minutes later at 10:06 a.m., SPX hits right on this candle here, mid R1, R2. The 10:06 a.m. candle, the 66.45 call is now $20.32. You paid $13.60. At 10:26 a.m., SPX hits the YDC level. YDC stands for yesterday's, or you could look at it as previous days, RTH session close. Before we move on, we'll go over these levels now. These were also in addition to the version 2.0 version of this indicator. We have 5 new key levels that were added. PMH, which is the pre-market high, PML, which is the pre-market low, YDH, which is the previous day's RTH session high, YDL, which is the previous RTH session's low, and YDC, which is the previous RTH session's close. These are also very important key levels to be aware of, especially when those levels coincide and have confluence with either midpoint levels or main levels. They can also be used as decisions for exits as well. So in other words, when we've hit yesterday's daily close here at 10:26 a.m. on this candle here, if you were more inclined to take a early close on your positions, then the odds are that it's either going to fall back down after hitting yesterday's daily close, or if it keeps closing above it, there's a very good chance it's going to hit at least YDH. And if it starts closing above YDH, which was the previous RTH session's daily high, then there's a very good chance it's going to continue tracking up to the next midpoint or next main level above, which, as you can see here, that's exactly what happened. It went above, it tested it, it tested it, it tested it, it closed back above it, and then it seeked out this midpoint level, and then it seeked out this R3 level above. So these also help in gauging momentum and also give you additional decision points, especially when they have confluence with other levels. Where you exit on your position as it's becoming more and more profitable, that's up to each individual trader. Some people prefer just scalping and getting out with small profits. Other traders want to hold on for larger and larger profits and adjust their stop losses as it keeps tracking upward. Other traders trade multiple contracts and are of the mindset that they prefer scaling out and adjusting their stop losses as price continues to move in their favor. How you determine which one of those kind of traders that you are is just in practice. That brings up a point about using this indicator. When you start using this indicator, just keep in mind that whether it's our indicator here that you've purchased, or you're using another indicator, or even if you're using a free indicator, you always want to practice with that indicator for a significant amount of sessions before trying to use it on a live real money account. So as an example, Charles Schwab's Thinkorswim has a very good platform. The Thinkorswim platform is very good for live trading as well as demo trading, and has one of the most realistic data for demo trading as far as options. So it will give you a very realistic prices on entries and exits even in the demo mode. Other brokers have demo accounts as well. In our experience, Thinkorswim has the best data for using a demo account and the most realistic data. Other providers such as TradeStation and other people do have demo accounts that you can practice on. However, their data is usually on the demo accounts not very good or not very consistent, so it's not really giving you realistic pricing on entries and exits. So just keep that in mind, that if you do want to demo trade and practice using this indicator, then we'd recommend that you take a look at the Charles Schwab Thinkorswim platform and using the demo account. Just remember, if you are using a demo account to practice with, always make sure that you're selecting the demo account and always reconfirm that you're on the demo account before you place any trades. So generally speaking, how many sessions should you practice as a minimum? Typically, you would want to, in most cases, at least practice 25 to 30 sessions, or it could be more than that. The reason being is that that will give you a full cycle of different types of sessions, and you will also go through the experience of days where you're going to have losses, days where you have both wins and losses, and days where you have wins and no losses. Then, after experiencing 25 to 30 daily sessions of using this indicator, you will become more and more comfortable in using the indicator, the process of trade entries, managing your trade and trade exits, placing your stop losses, managing stop losses as price moves more in your favor, and then also your target exits. And you'll also begin to see what type of entries that you prefer to take. Do you prefer to take them on the 9:30 a.m. candle, or do you prefer to wait? And also, do you also like taking entries later on the session off of other levels? But the main goal overall is for you to get the process down, become very comfortable with the indicator before using it on a live real money account. That way, when you do start deciding that you feel comfortable enough that you have the process down and you're satisfied with the results of using the indicator, then at that time consider then using it on a real money account. Of course, every trader is different. Some people will just ignore that and just start using it right off the bat on a real money account. I would suggest that you do not do that, that you still practice for a number of sessions until you become comfortable in the process of using the indicator for your entries, your stop losses, your target exits, and managing your trades. Alright, so now we're going to go back to these levels here that we were talking about. So this table here, as well as this table here, are both optional to turn on. So if you prefer not to have the tables on your screen taking up screen real estate, you can simply uncheck them in the user control panel to turn them off. All of your line labels here also have individual offset controls, and all of the line labels that you see for all the different levels have individual controls for both the color, line width, and line style, as well as the size and placement on the chart of the line labels. What that means as far as placement is an offset. So this is the offset that is the default offset as you see now. If you prefer to move, if you prefer a different offset, you can move the labels more to the right or more to the left by changing the offset. You can also make these line labels for each individual type of line label smaller or larger depending on what you like. Right now these are set to normal size, these levels here. The main levels I have set to large. The midpoint levels I have set to normal, and the quarter levels are set to small. You have the capability of, in the user control panel, of changing those to your liking. Again, as I mentioned earlier, we have another video that's about an hour long that goes into great detail about all the inputs and features of this indicator, which if you do want to see the video on that, you can simply email us at daytradinggps@gmail.com, and we can send you the link for that. If you do already have the indicator and are using it, then you've already been sent the link for it when you purchase the indicator. Okay, so we're just going to go back to, we left off here at 10:26 a.m. when it hits yesterday's daily close in the RTH session. Then the 66.45 call is now 21.40. Before that, we had at 10:06 a.m. where it hits mid R1, R2. Mid R1, R2 is 1.5 levels above the bull bear key price level. 1.5 levels above the entry that you took from the signal at the bull bear key price level if you took this entry here or here. One and a half levels above is our suggestion for minimal target for closing out your positions or making adjustments to your positions. Of course, that's up to each individual trader. As I mentioned earlier, some people prefer scalping and they want to take profits earlier. If you do that, then of course you would certainly not even consider doing that until it's at least hidden one level above, which above the BBKPL entry, which would have been this R1 level. So at least a 1.5 level move above on a bullish entry from the bull bear key price level, which is your mid R1, R2 level. So this here at 10:06 when it's 20.32 would have given you a nice profit from your entry of 13.60. Your next consideration would have been when it hits YDC and it was 21.40. Your next consideration would have been 10 minutes later from hitting YDC at 10:36 a.m. it hits R2, and now the 66.45 call is 24.39. 8 minutes later, you have another decision here if you're still in the trade when it hits the yesterday's daily close level. Yesterday's daily high. I made a typo error here. The call, 66.45 call, is now 28.28. So now you have approximately $1,500 profit on this hit of the YDH level. Before we go over the rest of these, we'll just point out that we did mention earlier that there are people that do trade multiple contracts and like to scale out of positions rather than closing out 100% at one price target. So if you're that kind of trader, then at 1.5 levels above the level that you had the entry signal from that you took your trade at, that's when you would want to close out your majority of your contracts, and then you would adjust your stop loss by one of two methods, which we'll go over with in a second, to leave your runners for seeing if the move will continue going in your favor throughout the rest of the session. Your two options here, we'll just take 10 contracts as an example. This would probably be for, as far as multiple contracts, people trading at least like 4 contracts or more, because normally you would want to, when you're scaling out, the idea is that you would want to close out the majority meaning somewhere between 70% and 90% of your contracts, and leaving the remainers as runners after adjusting your stop loss on the runners. So for example, on 4 contracts, if you sell 3, leave 1 as a runner. On 5 contracts, you sell 4, leave 1 as a runner. on 10 contracts, you could sell either 7, 8, or 9 of them and leave either 3 if you sold 7, 2 if you sold 8, or 1 if you sold 9. Then you would leave the runner and adjust your stop loss by either one of two methods. Either adjusting your stop loss to a different level. So from this was your beginning stop losses here. So when it hits 1.5 levels above, then you would want to move your stop losses to either the mid BBKPL R1 level or the R1 level if you're adjusting it by levels. The second method is just adjusting based on the price that you paid for the option. So if you paid $13.60 for that option, then when it hits up here at 2032, at the very least that you want to do is make it break even. So then you would adjust your stop loss to $13.60 and make it break even at this point here on the remaining runners. Or add a cushion to the $13.60, like make this $14.60 or $15.60 as an example. That way if price, after you've sold the majority of your contracts on the runners, if price starts retracing and does hit your stop loss, at least you still have a profit on the runners, and then you had all of your profit on the majority that you sold when you made that adjustment. Then as price keeps moving in your favor, you employ level-to-level trade management. So at each level, you can keep further adjusting your stop loss, moving it up if by levels to as it moves up one full level, then you would move up your stop loss if tracking your adjusted stop loss by levels by 1/2 level or 1 mid-level. So for example, if this was your adjusted stop loss here, then when it hits the next level here, then you could adjust your stop loss up another 1/2 level. Then when it hits this level here, you move it up another 1/2 level, which is another 1/2 level from here is this main level. Then when it moves up to another level, such as it did here, then you would adjust your stop loss up another 1/2 level, which the 1/2 level from that would be this level. Or if using the other option, then you would take it from $13.60, which was break even, or if you did have some padding there, then you just keep adjusting the stop loss by increasing the price of the stop loss as it moves up. So let's just say if it was $13.60 here, when you hit here, then when it moves up at each level, then you just add more, changing $13.60 to perhaps 17 or 18, then changing it to 20 to 22, etc., etc. The exact amount would be up to you as far as striking a balance between still giving it enough room to move because it's still going to fluctuate and having enough additional padding to where, again, if it starts retracing, that you would still have a nice profit on that last adjusted stop loss. Okay, so we left off here at 10:44 a.m. It hits yesterday's daily RT8 session high. The 66.45 call was now 28.28. That's on this 10:44 a.m. candle here. Here it's nearing the R2, R3 level. The call here was $35. That's at 11 o'clock. Here on the 12:10 p.m. candle, it actually hits and touches mid R2, R3. The call is now 33.70. Well, why is it 33.70 when it went up a little higher than here, when it was $35 here? Well, that's because this was 11 o'clock, and remember these are 0DTE options. And here, we're an hour and 10 minutes later. So even though this is way in the money by now, there's still some time value to the price of this option. So that time value is going to deteriorate a little bit over the time, whatever time value was left. So that's why it's $33.70 here, even though here it's a little bit lower and it was $35 actually higher. Okay, here at 12:38, which is this candle here, the 66.45 call is now 43.20. So this is this candle here, 12:38, when it's nearing R3. Here at 12:56 p.m., it actually, as you can see, hits and touches and goes slightly below R3. On this candle close, on this candle, when it touches, when it actually touches the R3 within that intra-candle, the call was now 46.20. So now we've gone from 13.60 to 46.20. Now we have a profit of just slightly under $3,300 per contract. Which, remember, if you were trading 10 contracts, let me back up a second. If you're trading one contract here, your cost is $13.60 for your price of that. However, your actual cost of a contract is $1,360, because remember, with options, you have to multiply the price that you paid for the option times 100. So if the price of the option is $13.60 times 100, that's $1,360. So now up here, you multiply this times 100, so that would mean this option here was $4,620. So if you bought 10 of these down here, you would multiply 1,360 by 10. So 1,360 times 10 is 13,600. Up here, it would now be worth, you take 4,620 times 10, it'd be worth 46,200. So as you can see here, we've bumped up again. It did back off some, tried again, backed off. Now it's went up again. Now it's backing off again. Okay, so now we're at the end of the video. I'm going to bring up a few more important points. One of which is that we'd appreciate it if you would like our video and subscribe to the channel. That helps us with the YouTube algorithm. And we would appreciate, we've appreciated you taking the time to watch this video today. We have about 15 other trading videos using the indicator. This is the second video we've made with the version 2.0 of the indicator. Most of the versions before that, most of the videos before that are on the original version of the indicator, which does not have the pre-market levels and the previous daily RTH session close levels. The previous version also did not have the quarter levels that were auto plotted for you like they are in this version. But it did have the midpoint levels as well as the main levels R1 through R6 and S1 through S6. If you have an interest in purchasing the SPX Daily Key Levels indicator, you will receive both versions of the indicator, the original version and also the V2.0 version. With your purchase, all of our indicators are sold on a one payment for lifetime access basis. And you can, we have a link in the description of the video that you would go to purchase the indicator, which is, that link is www.whop.com/SPX indicator. So that's www.whop.com/SPX indicator. And in return for you taking your time out of the day to watch this video, you can email us at daytradinggps@gmail.com to request a discount promo code for the purchase of the SPX Daily Key Levels indicator. So just simply send us an email at daytradinggps@gmail.com to request that special discount promo code, and we will send you the discount promo code that you can use on your purchase of the indicator. Okay, so this will conclude today's video. And thank you again for taking the time out of your busy day to watch this video, and we wish you prosperity in all of your future trading. Thank you.